All right, everyone. Thanks for joining today. This is our stock market weekly update on October 14th, 2019. And here in the US, we're actually on holiday. Well, it wasn't a market holiday, but a lot of people are off work and markets were pretty quiet. I think a lot of people were taking a 3-day weekend. So Columbus Day or Indigenous Peoples Day, whatever you want to call it these days, the market was pretty quiet. And yeah, there wasn't a lot going on. There was still, people were still talking about kind of the end of last week and what's happening with the U.S. China, trade war. Obviously, the U.S. China trade talks were the big market news, moving the markets last week. And markets were up about 1% for the week. Europe was actually up a little bit more than that because they got some positive news on the UK Brexit front as well. Looks like there might be a deal in the works there. But the U.S.-China trade talks ended in a tentative agreement. There was a lot of debate in the markets among market participants about whether or not this was a significant milestone in the whole U.S.-China trade war. So it sounded like the agreement was an agreement in principle. It hasn't been put in writing yet. The U.S. and China still have to sign it, but it was basically it was kind of one of those things too. It was like a phase one. They called it a phase one deal, where they want to actually have some other parts of the agreement put in place later on and signed later on. But for now, the U.S. is going to postpone putting more tariffs on Chinese goods, and the Chinese are going to purchase some more of our soybeans and agricultural products. So in the grand scheme, not that big of a deal, but the market saw it as a positive that the U.S. and China trade talks had finally taken a positive turn for the first time in a while. So that sentiment, positive sentiment about the relationship, actually was enough to push the market up a little bit for the week. So S&P and NASDAQ still up close to 20% year to date. I think 19% on the S&P 500, 22% year to date on the NASDAQ. So the market's still having a pretty good year. And Europe and Asia were up as well. And those markets are up anywhere between 10 and 20% for the year, depending on the market. So overall, I think we could have a decent end to the year, depending on what happens with the earnings season. And speaking of earnings season, it actually kicks off this week. So the bulk of it will really start in the next couple of weeks. But this week, we get a lot of big reports from financials and transportation companies. So on Tuesday, we've got earnings reports from the likes of JP Morgan Chase, Goldman Sachs, Citigroup, Wells Fargo, Charles Schwab. We do get United Airlines and Prologis. We do get a tech company on Wednesday with Netflix. And we also get like Progressive Insurance. And on Thursday, we get Atlassian, which is another software company. So we do get a couple of tech reports, but relatively limited on the tech side. A lot of financials reporting this week. On Thursday, we also get Morgan Stanley, E-Trade. And then I think there's some more industrial and transport names reporting as well this week, like Honeywell and United Rentals on Wednesday. On Friday, we get a few names as well, like Coca-Cola, American Express, Synchrony Financial, State Street. So yeah, a lot of banking and finance and some industrial and transport, and then one or two handful of tech names like Netflix and Atlassian. So a pretty good chunk of companies reporting this week. But yeah, we'll have to see what, especially it'll be interesting to hear, what JP Morgan and companies like that, or Citigroup that have a pretty broad view of the economy, have to say about what they're seeing for, general economic trends and business trends and things like that. So it's always interesting to tune into some of the banking earnings reports. And so that's some things that I'll be looking for this week. On the macro data front, not a ton of stuff. We do get September retail sales data on Wednesday for the U.S., and then some inflation rate data as well on Thursday. And yeah, actually, we had inflation rate data last week for September, which was in line with consensus for the month of September. So that looks pretty good. And the consumer sentiment that we had last week on the macro data front looks pretty good too. So we could be setting up here for a nice year-end rally in the market. Again, depending on what happens with the earnings season. If corporate earnings are trending back up in a positive direction in the next quarter or two, a lot of it probably hinges on the guidance for what companies are seeing for Q4. So, but depending on that, we could have a nice rally to end the year. You can see there's certain stocks that are signaling positive momentum, like Apple's, basically at its all-time high again, which is great to see for, a large consumer company that touches a lot of different parts of the economy, in terms of, its suppliers and obviously consumer spending on the customer side. So yeah, that's a good sign to see. And then, I was also looking at, the semiconductors looking like they want to rally. Someone had mentioned in the channel today, Taiwan Semiconductor is a company that they've been holding, and that's doing well. Again, it's hitting a multi-year high. So that sector seems to be looking pretty good. There are a few others, we could get, if the U.S.-China trade talks get, continue to move forward in a positive direction, we could see some of the Chinese stocks that we've been watching that have been sort of beaten up this past year. We could see some of them start to rally. We could see, potentially, if the economy turns back in the right direction, we could see a rally in some of the beaten up cyclical names that I've talked about as well, which we're not seeing really yet. I was noticing today, for instance, Mastercraft, which is one I've talked about, still trading for about 6 or 7 times this year's earnings. Not really signaling much turnaround there. I've talked about Lear. Lear had a little pop last week. Let's look at a daily chart here on Lear. Yeah, it had a nice little pop off that. I said if it, dips down towards 100 or below 100, I'll probably make the position bigger. Still going to hold that line for me in the sand. But it had a nice pop last week. So maybe there's a little bit of signal there, but still a lot of these names and most of the auto names are still down pretty significantly. And so, we'll wait and see if these kinds of names can rally with the market. If we get some leadership and we start to see earnings season really roll out positively. So that's kind of what I'm waiting for. I'm not making any, I didn't have any position changes this past week. No major, shifts in my portfolio from that standpoint. Just going to really take in the information from earnings season and continue to see, what happens just kind of generally. So that's pretty much it. In terms of the watch list, I don't think there was any major news from many of our companies last week. I talked about some names that had been coming in, like Macerich is still there. It's still looking a little bit weak. Retail, not really picking up just yet, but we are going to go into the Q4, big season for retail here starting in the next few weeks. So it'll be interesting to see how names like Macerich and some of the actual retailers perform. Yeah, other than that, I think there hasn't been a whole lot of news related to our watch list specifically. I wrote about GoPro last week. I talked about it a little bit at the end of the last call. But if you guys want kind of a deeper take, as always, you can check out the, I think it's stockgeek.substack. We'll pull it up here. I spelled it wrong. There we go. So I wrote this article called "Can GoPro Be a Hero?" It kind of just breaks down what's been going on historically over the last couple of years with GoPro, some of the issues they faced, and why the stock's just been crushed. It's at a new 52-week low, hit a new 52-week low last week. So I wanted to take a look to see, is there any improvement here? Is there any opportunity for a turnaround and potentially to make money in the stock? And so I talk about that. And I talk about the financial results of the company actually improving over the last, especially over the last year or two. So yeah, check that out. The conclusion I came to is basically like, I'm kind of in wait and see mode there. I think they need to show a few more positive signs that they can actually succeed in some of the areas that they're trying to succeed in, like software and subscriptions, and then see how the new hardware is selling. They did start shipping the new Hero 8 cameras last week. So the stock did have a little bit of a pop, but yeah, it'll be interesting to see how that does in the market. So yeah, check that out. And that's a stock I'm going to keep watching. I'm not ready to make a big play there yet, but it's got about a $550 million market cap. They're doing about 1.2 billion in sales. They so stock price, per share stock price today trades for around $3.65. Management has guided to around, I think, 35 cents a share in earnings for the year, but all of that is basically going to come in Q4. So again, that's another reason why you kind of want to wait and see how things are panning out, because they have not been profitable through the first 2 quarters of the year. So it's all going to come down to basically Q4. And and so that'll be interesting to see, because that will be the first positive profit there at GoPro in over 3 years if they can pull it off. And that would mean the stock would be trading, if you divide those numbers, $3.64 divided by, an estimated 35 cents in per share earnings. That's just over a 10 times price to earnings multiple. So that's obviously not an expensive multiple relative to like the market average, which is around 16 or 17 times. But GoPro has had its issues. So, it's probably not going to trade at a market or above market multiple until it proves it can consistently generate positive earnings and cash flow. So the other thing I think is, I'm really waiting to see if they can keep getting traction in some of the higher margin parts of the business, like the software side and the subscription side, which I talk about in my article. If they can do that, then this does have the potential to be a multi-bagger stock, because if those businesses grow fast enough, they're high enough margin that they can double or triple the earnings per share here at GoPro if they're successful with those efforts. So I talk about that in the article more in depth. But yeah, I mean, I think I need to see a little bit more proof from the management team here that things are moving in the right direction before I take a bet on this stock. But it's an interesting one. A lot of people, similar to some of the other ones that I've talked about in the past, like Blue Apron and things like that, it's one where people just look at the chart and see it as like this failed IPO that's going to zero. And I don't think the full story's been written here yet. So it's going to be interesting to see how it plays out. But a lot of people just, they look at the chart and they're like, this thing, POS, it's dead in the water. No reason for it to exist, and well, maybe there's a little bit of truth in that. But, I think there's probably some latent value here at some point. So we'll keep an eye on that one. Yeah, and really, other than that, I haven't really seen anything too compelling in terms of new ideas. We just have been kind of watching the existing watch list and trying to figure out what might be actionable over the next couple of months. The one that I was looking at was Devon Energy. Oil was down a little bit today. It was up last week slightly, but oil was down actually a little bit today, and that was kind of weighing on Encana and Devon, which are two of the energy names on our watch list. And, Devon's near a multi-year low again. It's a really well-run company. The problem is its sector, right? Oil and gas is like universally hated right now. But I think that actually provides an opportunity to find some valuable winners in this industry when everything's being treated, as one company, and you've got, multiple, tens of companies in this industry or hundreds of companies in this industry. There's bound to be some that are outperforming others. And so they're all under pressure because everyone hates the sector, but that's the time to be hunting for the individual ones. I think that can be longer term better than the rest. And so Devon fits that bill. They have good assets. They have a good management team. Let's just look up their investor presentation real quick. You can see some of the things that they've done that I think are positives. So, it's just a really, it's a U.S. oil and gas exploration and production company. They get about 3/4 of their revenue from crude. So they're not as gas heavy as some of the others, which is good because natural gas prices, we're in a natural gas glut in the U.S. and natural gas prices are reflecting that. So it's a tough time to be a natural gas producer. You can look at companies like Range Resources or Chesapeake Energy, and those companies are down like over 80-90% in the last 2 years. So Devon's faring a little bit better because they're a little bit more levered towards oil, which is good. But they're a shale producer, and you can see some of the areas that they produce. But they're really focused on shareholder value and on increasingly on cash flow. And so they've been paying down debt, and they've been buying back stock. I'll show you the share count in a minute because the share count has come in dramatically. And that's pretty unusual for an oil and gas company because most oil and gas companies, especially in the last 5-10 years, went sort of, aggressive in terms of expansion, spending capital on new wells, buying other companies, increasing their, reserves for the future. So Devon has had a pretty disciplined strategy. They've actually been selling some non-core assets lately, cutting costs, focusing on shareholder returns for the future. And the biggest thing is, reducing debt so that their leverage ratios are super low, which means that they're going to be able to survive any kind of prolonged industry downturn. So, excuse me, guys. Sorry. Yeah, and just going through their presentation, you can see that they've got the focus on, shareholder value, on optimizing cost structure, doing things strategically to position themselves. So here's a great slide, right? Here's the share count reduction. They actually show you since the beginning of 2018 through the end of this year, they expect to have gone from, almost 527 million shares to around 380 million by the end of the year. So that's a reduction of, over 25%. And so that's really significant from a shareholder perspective, especially for a company in this industry right now. That they're really focused on buying back shares while the stock is cheap, making sure that the existing owners, that they're returning capital through dividends and share repurchases, and in addition, they're reducing debt, right? So you can see here in this part of the slide, they talk about the uses of their cash over the last 2 years. And you get a little bit of dividends. The dividend's not super significant, but the two biggest parts are reducing debt and buying shares back. And so that's really a something that shows you that the management team is focused on trying to drive returns for shareholders. So, and of course, they do need to invest some capital back in the business here, which is what you see in orange, and that's to continue to explore and find new producing assets. So. That's important for an E&P company. Otherwise, you're basically in wind down mode. So, but you can see here the net debt ratio is below 1 times net debt to what they call EBITDAX, which is earnings before interest, taxes, depreciation, and exploration expense. I don't actually think that's the best ratio to use, but it's fine. A lot of oil and gas companies use that particular metric. But yeah, their debt ratios are pretty reasonable. They don't have any debt maturities until 2025. So, there's really not a concern on the balance sheet here. They have, I think, well, let's just look at their balance sheet real quick. I was just looking at it a few minutes ago. You can see that, let's scroll down here. This is the most recent quarter that they reported in June, or ended in June. So if we look at the balance sheet down here, you can see they've got about $3.5 billion of cash and then about $4.3 billion of long-term debt. So almost enough cash to cover long-term debt fully. And if they keep producing cash, they will be in a no net debt or a net cash position in a couple of years. So they divested a bunch of their Canadian assets. They did that in Q2. And so they did that at about a 10 times cash flow multiple, which is a pretty good price for those assets, which are kind of not being priced very like at a very attractive level right now. You can look at any of the Canadian oil and gas producer stocks and see that. But in any case, they decided to sell that, reduce debt, and gives them more cash to focus on their existing U.S. plays where they have a lower cost advantage. So this is a company that seems to be focused on the right things. The stocks come in a lot, so it's not cheap on current estimates. It's not like super cheap. I think Encana is actually cheaper, but let's just look. I think they're expected to earn about $1.50 to $2 per share. So it's 10 or 12 times expected earnings, which for a really well-run company, if you were to find a company in outside the oil and gas industry that was executing like they were, it would trade at a higher multiple. But yeah, right now, and estimates have come down with oil prices last year. But yeah, they're expected to earn about $1.90 next year, and then $2.30 the year after. So, if we assume the $1.90 estimate is right, then at today's price, it's trading at about just over 10 times expected earnings. See, here's the chart. It's trading for just under $21 today. So pretty cheap for one of the better run companies in the industry. And if we do get some industry distress again, and these stocks continue selling off, then this is one of the ones that I think you want to own in the sector as a longer term winner. So yeah, and they expect to continue to grow their production, reducing costs, increasing their margins. And yeah, I'm guessing they're going to keep buying back stock because they think it's cheap. And that gives you a tailwind as a shareholder. The stock should get cheaper if they continue retiring more shares at these levels. So yeah, y'all can go through this presentation yourself. I think it's a pretty nice one. They have a just a really clean presentation where they kind of put everything in focus for us, which is nice. So that's Devon Energy. So that's one I'm keeping an eye on right now, given that it's been under pressure. You can see just like in the last month, it's been anywhere from like $20 a share to almost $30 a share. And now we're back down here. So it's, it's volatile with expectations about energy prices right now. So that's Devon. Other than that, I'm just looking through the list here. I don't see anything that's super newsworthy at the moment. Like I said, it's a bit of a quiet start to the week. And last week was very much, market was focused on trade stuff. There wasn't a lot of specific company news. We're also kind of in this weird, given that we're like a couple weeks before earnings reports for a lot of companies, we're sort of in this blackout period where there isn't much news on a lot of companies until they report earnings. So that's another reason why things can be a little quiet. Calm before the storm, if you will. So that's really all I have this week. I know it's a bit of a short one from me, but I'm happy to talk about any stocks you guys are interested in or any questions you have, anything you're seeing out there that you want me to address. I know Google was supposed to introduce some new phones today. Qualcomm's got like a 5G event this week. There is a cannabis conference. Don't know if much is going to come out of that. Been watching the cannabis names. They've been under pressure, like I talked about last week. They continue to be under pressure. The stock charts do not look good. And, the valuations and market caps on these things are still pretty big. So, but the pricing, like a lot of these companies obviously entered the Canadian market and people were really excited about it. But the prices per gram of their products that they sell have actually been under serious competitive pressure as I expected. There's just a lot of competitors fighting for a market that's not that big today. Now the market's going to get bigger as it deregulates everywhere, but until then, it's a pretty fierce competitive environment. But there is a conference this week, and then I think the Pinterest lockup. I don't believe there's any major IPOs on the docket this week. But the Pinterest lockup does expire, so we might see some selling in Pinterest, which is, we may already be seeing it here today, down 3.5%. Could be under some pressure this week. This is actually a company whose growth rates I really like. I think it's well managed. Sort of flies under the radar in terms of social media stocks. I think it's still a little bit pricier than I'd want it to be. I'd probably look at this closer to $20 or under $20 a share, which would be closer to like a 10 or $12 billion market cap. But you can see the most recent quarterly growth rates, they're growing over 50, 60% in the most recent quarter in terms of revenue. Not profitable yet, of course, but they do have a really nice growth rate, and seems to be pretty well run. And they, I think, in their longer term targets, it's hard to say what this company can be worth, but I probably need to do some work on it to really get an idea of what I think on a longer term valuation should look like for this company. But so they're basically, for those of you who don't know, whenever a company goes public and they have their IPO, insiders of the company are usually restricted from selling shares right after the IPO. Usually that period lasts anywhere from like 90 to 180 days, so 3 to 6 months, sometimes longer, and sometimes there are exclusions where insiders are allowed to sell earlier. But usually the IPO lockups are 3 to 6 months, and so those insiders, once that lockup expires, once that period where they're not allowed to sell expires, then insiders can actually start selling the stock. And a lot of that, a lot of times that means all of those employees, especially like at the mid-level, who got some shares and options that are finally worth something, and they've been holding them for 5 or 10 years, they're finally allowed to sell. And that's meaningful capital for a lot of the people in the middle ranks. And it can be life-changing for them. So that's why, you often do see this selling pressure, even if it's not coming from the top level execs. you often see selling pressure after an IPO lockup in these hot tech IPOs because the middle rank employees are selling their shares. So sometimes you can get, some pretty nice sell-offs in these companies that you otherwise might not get. Yeah, I don't see any major insider sales reported yet, but I think the IPO lockup is sometime this week. The IPO lockup expiration. Yeah. Well, looks like a lot of these IPOs are still under pressure today. Datadog. I know with Datadog, I think there was the analysts are allowed to, the Wall Street analysts are finally going to be allowed to publish their analyst reports on it this week. There's also usually a blackout for banks to cover it and write about it publicly for a few weeks after the IPO. So Datadog probably will get some analyst initiations and price upgrades this week. Smile Direct has been under pressure because they, there was some, I guess, legislation in California. I haven't looked at that legislation yet, but the legislation in California, I think, would make it harder for them to sell their products in California. And there was a short report also out on the company last week. And the short report was basically saying that this company is going to face increasing regulatory and legal threats because they are allowing too many patients who shouldn't be eligible for the retainers to actually use these retainers. So, it was an interesting report. I don't know. A lot of it was probably embellished a bit, but I did think it made some credible points about legal threats, and the orthodontic industry is definitely trying to shut Smile Direct Club down because it hurts, their volumes and their business. So Smile Direct's got a big lobby to face here. But the stock is down it's down over 50% now from where it IPO'd. It could be an interesting one. I think if you got some really deep panic selling in this and it dropped to like a 2 billion type of market cap level, I think today it's closer to 4. If you got another, 30, 40, 50% sell off in this name, I would look at it. I would take a serious look. Anything out there that you all are looking at? Haven't seen any comments in the Q&A yet. Yeah, pretty quiet out there. Well, that's all right. We should get a lot more, like I said, calm before the storm this week. We should get a lot more actionable things to look at, and earnings calls and news and new numbers from a lot of companies for Q3 here in the next week, 2 weeks, 3 weeks. So, yeah. Well, cool, y'all. Well, I'll end it there, and we'll talk in the channel. If you have any questions, or you want me to look at any stocks in particular, or you think anything's interesting, hit me up in the channel in Discord. And y'all enjoy the rest of your afternoon and evenings, and I'll see you there. Take care, y'all.